Thank you all for joining us. I noticed we have around 50 people, which is great. As I said, presenting today, as Evie said, Jordan KEVOL and Mark Freeman. We have apologies from Braden Vasseur, who has a family commitment and unable to join us today. I'd also like to mention that we have a new board member that came on our board this quarter, a gentleman called Carl DeMong. Carl's an experienced engineer, has a lot of exposure internationally, and most importantly, worked historically in the Brooks and Thorsby area. The first quarter was great for us. You know, we ended up achieving revenue of just on $30 million Aussie, just over $30 million Aussie, with an adjusted EBITDA of 18.1 million. We had great operational efficiency. We had a few bottlenecks and a few hiccups along the way, which Jordan will talk to you. But overall, the management team and the operating team did an excellent job in running the assets. The run in the oil price was fabulous, but as you know from last year, we took hedges out, which also limited some of our upside. But our recent financing has alleviated the need for us to lock in hedges going forward due to our financing facility. So we're going to have a lot more flexibility and a lot more free cash flow going forward as those hedges expire. But with that said, look, I'll hand over to you, Jordan, and let you run through the presentation.
That's great. Thanks, Glenn. Hello, everybody. Yeah, I'll give a bit of a rundown of the operations that occurred throughout the first quarter of this year. We had quite a bit of operations in the first quarter of this year. For our first half 2022, it was very much weighted towards the first quarter for capital expenditures and operations. Starting with our Pisces program in the Brooks area. We drilled 3 Pisces wells in the Glauconitic formation in our Brooks core area, and all 3 of them, Pisces 1, 2, and 3, came on production in Q1 of this year. Pisces 1 and 2 came on in late January, and the Pisces 3 well started flowing back in late March. Pisces 3, in fact, has been a stellar gas well. It was a bit of a surprise for us with very high pressure and very high gas rates. But at $6 to $7 AECO pricing for natural gas, we're actually quite pleased to see such high gas rates. So we've seen that well produce as high as 1.4 million cubic feet per day, and it has much more to give than that. It's still cleaning up. It's making oil as well. So we're performing some operational works at our battery facility to handle such high gas rates and such high pressure. And we anticipate being in a position to optimize that well further in the coming months. The Pisces 1 and 2 were great wells as well. Pisces 2 was a real overperformer. We saw some peak rates as high as 500 BOEs per day out of that well right off the bat, and it's still currently producing in the 275 to 300 BOE per day range. Also in the quarter, we completed the Gemini program. We drilled Gemini 5, 6, and 7. Those are sunburst wells in our Brooks core area as well. So what we did on the Gemini program was we drilled 2 horizontal wells, Gemini 6 and 7, and we also drilled Gemini 5. Gemini 5 was a vertical well, and it was designed to test a pool extension right in the heart of our Brooks play on some undeveloped land that we had, where our geological models suggested that there might be an expansion where we could prove up with some logs and a vertical test well, some future horizontal drilling. And as a matter of fact, the vertical well was very successful. It exceeded our expectations in that we put it on production, and it was an excellent producer itself, just as a vertical well. That well came on at well over 100 barrels a day, and even to this day is still making 75 barrels per day. So that makes us very excited for the future horizontal potential in that expanded portion of the pool. We see potentially up to 6 horizontal wells as a follow-up to that vertical. And the beauty of the location of that, the vertical well and that same pad that we would drill the horizontals off of, is it's right on the pathway of the recent major pipeline infrastructure project that we just completed, which I'll talk a little bit more on later. But very pleased with the results of that geological test, and also a nice bonus to see some production coming out, and good production coming out of that vertical well. So we do anticipate potentially in the second half of this year to drill the first follow-up horizontal well in the Sunburst to capitalize on the success of Gemini 5. Up in the Thorsby area, we've got, we had the Leo program, wells that we drilled in the fourth quarter of 2021, really came on production and came into their stabilized rates in the first quarter of this year. Current production for those 3 wells has been averaging about 1,000 BOEs per day. That's what they averaged for the March quarter. And they actually continue to produce at about that rate. They're stabilized, they're good wells, and they're continuing to produce at a combined rate of 1,000 BOEs per day. In addition to the Leo 1, 2, and 3, we also drilled Leo 4 in the first quarter of this year. Leo 4 was another Sparky Formation well in the greater Thorsby area, in a new area for us known as Holburn. It's some land that we've held since back in the Blackspur days. And we drilled our first well alongside our partner in the first quarter of this year. It looked excellent geologically, and that well is slated to be fracture stimulated as part of the completion, probably in June of this year, right in the second quarter. And with success, we'll frack that well, complete it, test it, and bring it on production. And if it's successful, it actually opens up quite a bit more of drilling that we don't have booked currently in the North Thorsby or Holburn area. So we're quite excited about the potential for that well. So stay tuned. We'll have more information in the coming months on the results of the Leo number 4 new area step out test. Then, as mentioned, we did a large scale pipeline as a part of a strategic infrastructure development in the Brooks area in the first quarter of this year. What it did was connected our 2 of 29 battery. That's our main oil processing facility in Brooks. It connected it to our other main oil battery, the 15 of 23 oil processing facility, and it accomplished a number of things. It allowed us to move production around in a more efficient manner and take production out of the 15 of 23 battery and get it up to the 2 of 29 battery. This well facilitated 4 of our Q1 drilling tie-ins, taking all of that production to our 2 of 29 battery. So Pisces number 3, Gemini 5, 6, and 7 are all flowing into this new pipeline that we put in the first quarter of this year. And then on top of that, we are also bringing on some legacy wells that the fluid from the wells has been trucked for the last number of years since they were drilled in 2018. And by turning these wells into wells that are trucked to our battery, into wells that are pipeline connected to our battery, what that does is it saves us $55,000 per month in lowered operating costs, because pipelines are the cheapest and most efficient way to transport oil and gas products. It also is very important from an environmental standpoint because we're taking trucks off the road. Trucks that would otherwise be hauling our oil and water to our battery facility are now off the road. And then there's also implications on the environmental side, where by taking trucks off the road, we are reducing our environmental footprint. So it's safety, it's environmental, and it's operating cost efficient. So very happy to have that pipeline in place, and we're very pleased to report that it was done significantly under budget. Everything went very well. The weather was very cooperative through the winter as we were putting in this pipeline, and our crews and engineers and planners did an excellent job. And that pipeline project was $650,000 Australian under budget. So very pleased that it went well. It was on time, and it was significantly under budget. Next, the waterflood expansion in the J2J pool. We've talked a number of times about it's a sunburst pool that we hold in the Brooks area. The waterflood was initiated in 2019 and 2020 via Blackspur, and during the period of COVID, it was kind of put on hold and shelved, but we are going to be finishing this waterflood project off, and in the second quarter, some money was spent in the first quarter, and by implementing this waterflood into the J2J pool, we are expecting to see a significant increase in reserves from the J2J pool, as well as an increase in production. So there's about 180 BOEs per day currently coming out of this sunburst pool. And by increasing the injection into the pool, enhanced oil recovery via water flood, the reservoir modeling that's been done suggests that we may see a 2 to 4-fold increase in the production of this pool. It's already started to flatten out. We've arrested the declines by the water that has already been injected into the pool. And over the next 24 to 36 months, we expect to see a significant increase in the production from this pool, and therefore the longevity of the pool and the ultimate reserves associated with this pool and the recovery factor of the oil in place. So it's going to be very impactful to overall reserves and cash flow out of this legacy pool that we have.
Thanks, Jordan. Just while we're here on the operational side, just got a few questions that have come through. Might be good to deal with them now. You talked about Leo number 4 being geologically attractive. Can you just elaborate a bit further on that? What makes?
Sure. So we drilled that well in the first quarter, and it was a horizontal well, and we landed the horizontal well and drilled approximately 2,000 meters of horizontal section in the Sparky age sand. And while we were drilling, we saw excellent oil and gas shows, high quality reservoir rock, oil in the samples, basically everything you want to see when you're drilling a horizontal well. It ticked all the boxes. So when you're going into a new area that doesn't have existing production out of a particular formation, you don't know what the level of oil and gas shows or quality of the rock is going to be necessarily until you physically see it in your hands and under your microscope while you're out on the rig. And we were very pleased that it ticked every box. It had really good gas shows on the gas detector. There was oil in the samples. The samples that were coming to surface, the rock samples, had really good porosity. So we're very keen to see what that well is going to produce after we pump the frac. So it has approximately 45 to 50 frac stages installed in the liner. And like I said, in the month of June, we're going to move on the frac spread, and we'll pump our fracture stimulation program on that well. So it'll all come down to the oil and water and gas ratios and the inflow. But from everything we could see while drilling, the geological indicators were very positive.
Thanks, Jordan. I think we'll move into just break things up a bit, just some of the corporate background for the quarter. Glenn gave us a good introduction with obviously we've had a very phenomenal quarter from a financial perspective. Our revenue's up 56% and profitability, most importantly, is up 93%. You should also be seeing a bit of a reduction now that we've got our pipeline up and running in the Brooks area. Our average OPEX was around $16 per barrel. And from a corporate perspective, we've had a lot of questions in relation to the fundraising that we undertook. The raising from our perspective gave us a lot of flexibility. As you can see, we've been able to run our working capital without using the credit facility. We've managed to pay the credit facility all the way down, and there's only about 0.4 of $400,000 drawn on that particular facility. What that means is the company is not forced to put in place hedges. Previous to that situation, we were required under the credit facility, to have 50% of our production hedged. Now that's no longer the case. A lot of the questions we see coming up from investors is, well, why aren't you making more money? Well, as you guys know, notwithstanding the fact that we had to put hedges in place, hedges are an extremely good mechanism to protect the company from the downside. And when we look at the hedges that we put in place, they were done at a time when the oil price wasn't sitting at over $100 per barrel. So I'll run you through a slide a bit later on and we can go through that. But we were very happy with the overall commitments under the facility, under the placement that we did. Canaccord put the placement together. We had overall demand of about 40 million, and we ended up cutting it obviously down to the 20 million mark. And we had a lot of contributions out of London through Auctus and Hannam Partners. As Glenn mentioned, Carl has joined the board. Very, very technical based operator, very good with people, He's so far made a really good impact operationally, and it's a great addition to the team. We also took the opportunity to list on the OTCQB. That's a facility that allows people in North America to buy and sell securities in their time zone, in their currency, and relatively easy on their own exchange. What we found is it's a real challenge to get people outside of Australia, other than people out of London, to come onto the Australian exchange. So it's been quite a big contribution. The main objective of the company now is we had delays in getting our Thorsby production up and running. We had a really strong quarter. The 3 Thorsby wells performed phenomenally. We managed to put an additional 4 wells, 6 wells on production, which is the Pisces 1, 2, and 3, and Gemini 5, 6, and 7. We spent quite a significant amount of capital in the first quarter. That capital has enabled us to increase production quite significantly. It's taken us to that average of 4,300 is what we're doing right now. And what we've done is to limit our downside on this next quarter is just to reduce our capital outlays. So we've got an estimated $3.5 million that'll be spent in maintaining what we've put in place, and that's basically to complete the Leo number 4 and undertake a bit more works on the J2J pool, along with some additional modifications to our main facility at Brooks. The expectation is that we will be undertaking a distribution back to shareholders or a share buyback. We haven't decided exactly what form that will take, but our critical obligation to shareholders is to show a return and get some money back to everybody. Just as a point of note, we averaged realized prices of about $108.54 on our oil, and gas was at $5.56. Now, whilst we initially put in place an expectation, we originally said we would meet 4,000 to 5,000 BOE per day. Right now we're doing 4,300 BOE. We're slightly at the bottom end of that. I'd actually like Jordan just to elaborate on some of the activities that we undertake on a day-to-day basis to get our production maintained and to ensure that the 74, 75 wells that we've got producing continue to produce. So Jordan, if you wouldn't mind running through some of the activities that we're dealing with at the moment, as well as, you know, expectations on Leo number 1.
Yeah, so I was having some audio issues, so you can hear me okay?
Yeah, you're clear.
Okay, great. Yeah, so there's quite a bit of work that's done on a day-to-day basis particularly with new wells. We're constantly optimizing the wells. We're doing a number of different projects, like I'll give you some examples. On Pisces number 3, because that well turned out to be such a strong gas well with high pressure, we had to pull the pump out of it because the pump actually turned out to be a restriction. And instead of which we ran 2 3/8 tubing into the well so that it could flow gas better and lift fluid. We do things like lowering pumps to optimize the production out of wells. When you bring a brand new well on, you generally run the pump a little bit higher in the well so that you don't overdraw on the well or bring any sand in. But then after the well has flattened out, you go on with a service rig and lower the pump to increase the efficiency of the well. We've had to do a number of coil cleanouts from time to time on some of our fracked wells. In fact, back in the first quarter, we did a coil cleanout on Leo number 3. We were experiencing some sand inflow from the frack job on that well, and it was impeding production. And after we completed that coil cleanout, that well came back on at 500 BOEs per day. I think it even touched 550 BOEs per day for a brief period, but it was at 500 BOEs per day after that cleanout. So it was a very successful operation.
So with the clean out, Jordan, can you just elaborate a bit further on, you know, what actually happens and why do we need to undertake these exercises, and, you know, what's it actually involved?
Yeah, so when we on our fracked wells, and not all of our wells are fracked, the Sunburst Formation has enough porosity and permeability within the reservoir that it doesn't need a fracture stimulation. But our glauconitic wells, and in particular our Sparky wells, the Leo program in Thorsby, what happens is we pump vast quantities of sand into the rock. We pump it down the wellbore and through specifically designed ports in the casing, and it goes into the formation. It hydraulically fractures the rock to create cracks in the rock, and then the proppant or the sand is forced via pressure into those cracks to prop it open as the proppant. And what that does is allow more oil and gas to flow into the wellbore. But what happens is sometimes that sand doesn't all stay in the formation. We do a lot of mitigating factors to ensure that it does, but at times, due to some pressure differentials and some downhole dynamics, you get some of that frac sand back into your horizontal wellbore. And as that frac sand flows into the wellbore and it starts to layer and create rock blockages, when you see a step change in the production of a new well, you realize that, uh-oh, we've got some frac sand that has flowed into the wellbore, and we have to go in with a coil unit, which is a big reel of steel coil and nitrogen. And we go in and we flush all of that sand out of the wellbore that has been impeding production. As you can imagine, on a 2,000 meter horizontal length well, if there's a blockage 200 meters in, you're not seeing 1,800 meters of potential reservoir that could be contributing. So coil cleanouts for frac sand are not always needed, but they are sometimes needed. And as we saw on the Leo number 3 well, they can be very effective in taking a well that has had a suspicious drop in production and really bring it back to life. And in fact, that brought that well back to higher production than it had seen since it was brand new. So it can be very effective. We don't necessarily do them as a normal course if we don't need to, because it costs money, and we don't do them if the well doesn't tell us they need them. But from time to time, and after a couple months of production and that sand has accumulated in the wellbore, it can often be something that is needed to maximize production out of the well.
Great. Could I just remind everybody, if you want to send through questions, please use the Q&A function and not the chat function. That'd be great. Okay, so the outlook that we've got for the second half of this particular half is the following. Our expectations, and we're not, we may end up with higher production, but our expectations are 4 to 4.2. And that's with no material increases in capital expenditure. So we're basically going to be completing the, as we've mentioned, the North Thorsby Leo number 4, but we won't see that contribution in production until the following half year. Sales revenue will be somewhere between 60 to 65 million Australian. Our adjusted EBITDA is 35 to 39 million. Funds flow, so this is after our hedges have been recognised, is between 20 to 28 million, and our expectations of capital expenditures 19 to 20. So just one of the questions that have come through is, why do we not report our profit after tax? Because the company has significant tax losses, there is no benefit in reporting that, because we're not paying tax, corporate tax anyway. All of the royalties and any other state taxes payable on the sale of oil and gas are already reflected in those numbers. So I think we've pretty much elaborated on the upgrades that we're going to be doing in the upcoming quarter. There's a few nice pictures, and we've got a very, I'll run through them quickly. So the H2 sweet plant on the left, basically when you're producing hydrogen sulfide, you have to extract that sulfide before you can transfer your gas into a gas plant. And the main way that people do this is they use a product called triazine, which is an environmentally extremely unfriendly product. We have a phenomenal facility at our 229 plant at Brooks. It's a state-of-the-art facility. It enables us to process the gas, to extract the sulfur, and then the sulfur ends up in a powder form, which can then be disposed of safely. And if you actually want to, you can go and process that powder a bit further and even sell that sulfur. It is a phenomenal facility. It forms part of the company's IP. We own 50% of H2 Suite, which owns this technology. And it's something that the Canadian market has to move towards as triazine becomes both environmentally unacceptable and more expensive. Particularly now that you've got gas prices up at $6 to $7 per MCF, there's a lot of stranded projects out there that'll need a facility like this. On our far right, we've got one of our well site supervisors, Dustin, who was overseeing the one of the water disposal wells. This is a previous producing well that's now been converted into water disposal. And I think Jordan mentioned earlier, we're going to be doing around about 7,500 additional barrels of water that we can dispose of as our 229.
Yeah, I didn't actually touch on that, Mark, but thank you for bringing it up. So we're just putting the finishing touches on a new project at our 229 oil battery, which, like Mark pointed out, is going to add 7,500 barrels per day of incremental water disposal capacity. So what it's going to do is facilitate bringing a lot of this new production that's coming into the 229 battery via the new pipeline project that we completed in the first quarter. It's going to facilitate all of the water associated with that fluid, as of course, when we produce our oil and gas, it comes with wastewater, and we're going to be able to dispose of all of our own wastewater as opposed to paying any third parties to dispose of said wastewater, which is, again, via a pipeline and into your own disposal well, is the most efficient way to, from a cost savings perspective, and again, environmentally friendly, because we're taking trucks off the road, and more safety with less trucks on the road. We're increasing the safety out in our field. So we already dispose of all of our own water, but some of our disposal wells were getting full, and we just recently converted one into another disposal well and added 7,500 barrels per day of that water disposal capacity.
Right. Okay, so just in relation to the Montney, we put out a significant announcement back on the 4th of April saying that we're really, we were dissatisfied with the traction that we received through the Peters & Co process. We got a few offers for taking on the Montney acreage, and they weren't acceptable from our perspective. The Montney comes with a significant resource, a contingent resource, which is partially defined as development pending. And what that means is that once we get a finance facility in place, that'll be converted to a 3P resource in respect of that component. Overall, we saw increasing production coming out of the Montney on a per well basis. Each well slightly, the new wells that are being drilled by our counterparts to the south have got increasing recoveries. The Montney itself produces around about 7 to 8 BCF of gas per day. And from that, with LNG Canada coming on stream in 24, 25, you're going to see about 3 BCF a day being taken out of that market. And together with this change in the geopolitical environment, we're now seeing gas prices above $6 to $7 per MCF. If you have a look at this graph here, when we got into the Montney, we were looking at gas prices well below that, within the $2 an MCF. And when we did our economics, we were, looking at, well, whilst it's predominantly gas, it does come with quite a significant amount of light oil, really high API oil, which has got a premium to your typical WTI. What we're seeing now with gas prices having increased and the forward strip on the gas prices has gone up significantly, it changes the economics quite substantially. We always also have a few questions, and some of them have come through today with respect to the Montney. In relation to the leases that we have in place, they are 9-year leases. They expire in 2029. The leases that were expiring this year. We took them out of our 2U prospective resource. You have leases that you have for around about 5 years. If you do not drill, then you lose the leases. The leases all sit to the north of us, and there's no activity by any other companies to the north. The north of us is predominantly stranded. So if you were to go up there and pick up that acreage and drill some wells, you're going to be spending a tremendous amount of money in trying to actually deliver those resources to a pipeline. We already have a pipeline. We own the Tommy Lakes facility. It's a short little pipeline that we'd have to lay to get our product from our two existing wells that are out there to that pipeline, and that'll enable us to deliver 50,000 MCF and 2,500 BCF a day. So overall, whilst we're still continuing to look at opportunities, the landscape for us has improved quite significantly. As we've mentioned in our releases, total consolidations in the Montney in 2021 and now including 2022 is around about $9 billion, including the recent Lacroto transaction. Just in relation to our hedging, and it's something that we just have to point out to everybody, whilst it's easy to say, hey, how come you've got all your hedges in place and you hedged 1,000 barrels at an average of 88.97 when the oil price is above 100 Canadian? Well, this is why. You can see where the oil price was at when the hedges were taken out. And more importantly, what we're going to be seeing over the next quarter is the vast majority of the hedges start to come off. So over the next 3 months, of that average 1,000 barrel a day, that's going to start to peel off significantly. And as we get to the end of this calendar year, we run out of our hedges. So that the scale on the hedges just drops down. Now, just a few more questions, Jordan. I'm just going to go back to them. What shortages, cost pressures are you experiencing in labor, materials, steel casing, and fracking sand? That comes from Nicholas.
We are seeing, we are planning for upcoming tightness in supply of all of those things that you mentioned. And you mentioned you're very correct on some of those. Steel across the world, doesn't matter if it's oil and gas or whatever you're building with steel. Steel is prices are going up, and it is becoming a little more scarce. Frac sand, yes, that's more of a US thing from what I understand thus far. So far we've had no issues sourcing our frac sand, but the cost of it is going up. Drilling rigs, same thing. It's not necessarily a lack of drilling rigs, it's a lack of personnel to man them. So we are planning for cost increases across the board, and I'm sure you want me to quantify them. It's probably what we're planning for is a range of 15 to 20% cost inflation on a lot of those things that were just mentioned. Some of them will be higher. Steel will be higher. Frac sand will be higher, but then some things will be more on the lower end. We haven't seen drilling rig prices really skyrocket yet. They're in fact not even, they're not back to the prices we experienced last time we had $100 oil circa 2014. So yes, cost inflation is a thing, as it is in all industries right now, and it is affecting our industry. Manpower is a thing. It is affecting our industry just like all other industries, but we're planning for it. We're having to do some more strategic planning about the timing of drilling and when we're going to access rigs. And it's not like 2020 or even 2021 where everything was cheap and plentiful because no one had ramped up drilling. It's $100 oil and $6 to $7 gas. So I don't anticipate that our second half capital program is going to be, we'll be able to get it done. And we have to plan for and expect some timing issues as well as some inflationary pressure to the tune of 15 to 20%. As of right now, that's what we're internally forecasting.
Right. Let's see. Nick Chan's got a couple of questions. Can you confirm what the current April average production is? 4,300 BOE per day, and are we expecting there to be an increase in May and June? So Nick, obviously go ahead, John.
Okay. As we know, April's not finished yet, and we have field estimates from our production, but we don't get paid for our production. You know, the actual tickets come in, and we get the actual hard numbers until the next month. But based on where everything, we're most of the way through April here, and we have had some downtime in April related to third party, our gas processor in Brooks. They did a 3-day turnaround in April. So we had to curtail our production back to 25% of daily production for 3 days. And then it took about a day, just about 2, for everything to come back to their peak rates. 3 days doesn't sound like much, but it certainly adds up over when it's only in a 30-day average period. We had a power outage that we experienced, a few well workovers. So production currently is 4,300 BOEs per day at this moment. With our water disposal capacity increase, which is occurring in the next 2.5 weeks, we're going to be able to further optimize some wells and potentially have an increase in production. We have a coil cleanout. I know we already talked about coil cleanouts tonight, but there's a coil cleanout that we'd like to do in the next couple of weeks up in Thorsby, because we think we can make an impact on one of those wells that is maybe not producing as much as it could, based on our very positive experience with the last coil cleanout up in Thorsby. We are evaluating the possibility of doing another one on Leo number 1 this time, versus Leo number 3 that we did in January. So there's a few optimization projects that we're endeavoring on over the next 2 months, which is what's left in this second quarter. So of course, production declines when you're not drilling new wells, especially when you recently drilled a number of new wells in the first quarter, and new wells have their highest declines in the first couple of months. So we're pretty confident we're going to be able to keep our production relatively flat through the next couple of months until we're in a position to start drilling again, based on optimization that has already occurred, the fact that we're through the worst part of the decline when the first month or 2 of the new wells, and some of these projects that we have upcoming during this period when we're not drilling.
Excellent. Okay. The volume on the OTC, Thomas has commented, the volume on the OTC is very low, close to 0. Apparently it's not readily supported by brokers. Can management address this in any way and look at a listing on the LSE? Thomas, you're absolutely right. The recent listing that we undertook on the OTC does require marketing to be undertaken. And we have recently appointed some management advisors for us in that regard. And we've got some meetings with home offices and other brokers on the exchange. And I think we'll find that as we start putting more effort into that particular exchange, we'll start seeing some results. Additionally, we are looking at other exchanges. The LSE is probably the most obvious opportunity for us. We've seen a number of companies that have Canadian assets that are listed on the LSE. Obviously, the only thing we have to balance with respect to an LSE listing is the cost of doing that and how much funds you need to raise in order to be on the LSE. So the minimum raising is probably around 20 to 25 million US dollars. And to do that, you're still going to be spending quite a bit of money in undertaking that process. And then you've got to use the money for a purpose. Obviously, we have a purpose. We can go out and drill more wells. Or alternatively, we can look at opportunities for acquisition. So it's something that we're working on in the background and keep that space open to yourself. Let's see. I think so. Stephen Matthews, just in relation to the recently completed 7-well program, Jordan, you've touched on the declines. Each of those wells we had. Each of those wells we had a different type. We had 7 different wells. There were 3 Pisces wells, which are volcanic. They all have different types of declines. In addition to one of them being a predominantly gas well, we then had the 3 Gemini wells. One of them was vertical. So, Stephen, with respect to declines, there's no perfect answer to that, but I do welcome you to get in touch with us later, and Jordan can run you through some of those decline curves. Just to make it really clear, we have no intention to raise any additional capital The company is extremely well placed. As mentioned, we have our debt facility, which is completely cleaned out. There's nothing, it's paid. We can essentially draw down 99% of it. So please, everyone, we are not raising any capital. Okay. There's a few comments on here in relation to Europe and the impact of Russia. Obviously, we're very conscious of the impact on oil and gas prices, as well as the reaction from the vast majority of the Western world in relation to how they're going to cope with the fact that they won't be able to rely on Russia. We've seen the results, obviously, in the oil and gas prices, and it's something that we're paying particular attention to. The Montney asset for us is definitely taking, is resuming its pole position as an opportunity for the company. It's a significant amount of gas that we have sitting in there, a lot of light oil, and we are working very, very closely on trying to unlock that value. Very good. So if I haven't answered any of your questions, it's probably because if I were to answer them, I'd probably breach some securities laws. So that being said, I think we've covered off most of the questions that have been answered. I really appreciate everyone's attention and their time. We're just on 45 minutes, so I think we've probably used up a lot of everyone's time in the middle of the day in Australia. So Jordan, do you have any other closing comments that you'd like to put forward to everyone?
No, I don't think so. I think we covered off everything. We'll be, we're working on our second half plans, which will be coming out to we'll be letting the market know what the plans are for the second half of this year in the coming weeks. Meanwhile, we're focused on optimizing all of our existing operations as much as possible. We're very pleased to see the balance sheet where it is, and continued strong oil and gas prices. So we're very much looking forward to that optimization for the next 2 months, and in the coming weeks, letting everybody know what the plans are for the second half of the year.
Very good. And just to let everybody know, obviously, if you have any other questions, please feel free to email them through to myself or Jordan. You can even bother Glenn. He loves to get on his phone and respond. In addition to that, we will be announcing, you're still on mute, Glenn. We will be announcing our H2 budget in the next 2 to 3 weeks, which will give everybody an idea of what we're planning to do for the second half of this calendar year. That's great. Well, thanks everybody, and have a wonderful day.
Thanks everybody for joining. Have a good night and day.
Cheers.